The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to our last Property Investing Matters show for 2020. When we aired the first show for 2020 at the beginning of the year, we couldn't have known what a roller coaster year it would be. And here we are, closing out the year, still a little unsure of how we will land in 2021. So to talk about that tonight, I thought it would be prudent to invite on the show the first guest we had at the beginning of the year, and we're going to chat about mining towns, the Perth market and commercial property, and maybe give a few thoughts about the future, or at least 2021. Now you can join in on the show by asking us a question, and this week up for grabs is my Christmas pack of books. And so every question that we answer on the show tonight will receive all 3 books in this pack. So let's get started on the show. Let me introduce this week's property expert, Damian Collins from Momentum Wealth. He's the founder and managing director of Momentum Wealth and also the chairman of Mayor Property Funds. He served on the Rewa Council since 2011 and was elected president of the Institute in 2018. Damian has a Bachelor of Business from RMIT University in Melbourne, a graduate diploma in property from Curtin University in Perth, as well as a graduate diploma in applied finance and investment through FinSIA. He's a fellow of the Institute of Chartered Accountants in Australia and a fellow of the Financial Services Institute of Australia. Let's welcome Damian to the show tonight. Damian, how are you doing?
I'm going very well, Margaret. It's good to be in Perth, where we're finally looking up after many challenging years. So it's going well.
Yeah, absolutely. And I don't know if you recall that you were the first guest on the show at the beginning of the year. So I thought it would be great to get you back on and reflect a little and update everybody on where you guys are at over there in Perth. And maybe at the end you might want to give us a few of your thoughts on 2021, generally speaking as well. But let's start with those mining town properties. You know, I've seen people make great fortunes from them. I've seen people lose great fortunes from them. And I guess at the moment, some of them are looking okay and looking like they're booming, and that's going to be very attractive for investors who want to make some decent money. Can you tell us which ones are doing well at the moment?
Well, good timing, Margaret. I was actually up in Port Hedland only last week, and reason being is we bought about $12 million of property up there in 2019, towards the second half of 2019, on the very basis, and we did it in a fund, so we didn't do predominantly. So clients put in some money into a fund and we pulled the assets. And reason being is obviously to check out what was going on. Hadn't been up there for most of the year, and it is going gangbusters, and that's the only way you can really describe it. It's I sat down with one of the local agents and she went through the 18 sales they had in their office for the month of November up until the day we were there only last week, and every single one had sold more than asking. So it's a real fear of missing out market, and so it's particularly strong. Rents very strong. A shortage of rental properties. In fact, they've got next to zero vacancy rate. So this is what happens in mining towns. It's good to ride the wave up, but you've got to be cautious about not riding it all the way down again. And as I always like to reiterate, and the reason we bought the properties up in Karratha and Port Hedland last year was the fact that we could see what was going on with infrastructure investment in the mining expansions, and the prices were down 70% in Karratha, 80% in Hedland, and well below replacement.
So Damien, you've sent me over a visual here. I want to bring that up now so you can just talk us through it. Hopefully it can be fairly easily seen. Let's have a look at that visual now. What can you tell us about this?
Yeah, well, they were the suburbs that was only recently released by REWA in terms of the prices, and you look at the growth. So the top, Bayton, Bulgara, Millers Point, Millers Well, I should say, Nickel and Peggs Creek are all suburbs of Karratha, and you can see there 20 to 25, 36% capital growth even over the last 12 months, and Karratha, for those who don't know, has got two main industries, so it's a bit more diversified than Headland. It is got a lot of gas projects, so it's got Woodside on the Burrup Peninsula. It's got Chevron's massive investment, which is at Barrow Island, but nonetheless that tends to feed into Karratha for a lot of servicing. And but it also is a port, and Rio Tinto is almost all of their iron ore in WA, or a good chunk of it at least, goes out of Karratha. So that was a big story coming into, and that was the one that took off first. Now, when you get into Port Hedland and South Hedland, that's the two suburbs for residential property in the Port Hedland region. You can see it over the year didn't really do much, but the last quarter, this is where it's really taking off, 8.5% and over 4% in South Hedland. So, look, if I was buying something today, and obviously it's speculative money, and I'm sure we'll talk about that versus investment, Hedland has still got a fair bit to go. I think Karratha's got maybe 25, 30% in it before it gets to replacement, but Headland's still got about 45, 50%. And ultimately, the pricing up there will come back to long-run replacement value, and that's around 700,000. It is very expensive to build up there because everything's shipped from Perth.
So Damien, we all know that investing in mining towns is definitely, as you said, a speculative investment, and we all know people who bought way too late when it was near the top, thinking that it was never going to end, and they lost an awful lot of money because even looking at those prices in the table that you just showed us, they're all way, way lower than where they got to during the last boom. Is the mining town property one that you have to be able to buy at the right time and then sell within a foreseeable future, or are you better to buy it and just hold it for 20 years?
No, definitely not. It's definitely, look, I think generally my philosophy is capital city property prices, you never say you never sell, but you're tending to look for more a long-term investment. You might take some off the table, and if you've got a bigger portfolio, move it to another city, take into account your transaction costs. But a mining town, you should never be there long-term because they tend to boom and bust. And you mentioned that. I mean, some of the ones we bought in Headland for in the 250s to 350s last year, I saw the pain when you looked at RP data and saw that some of those had been paid, they'd paid 800, 900,000 for. It was mortgagee sales. It was very, very painful. And I think I remember both of us were at an expo in 2011 and 12, and people were talking about mining towns, and we were trying to talk them out of it because it was overcooked. And but unfortunately, most people buy at the top. So yeah, we bought in specifically for a 3 to 4 year cycle, and our fund will be out of those towns, whether it be 2022 or 23, I don't know yet, but we won't be there the long run because it'll get to a point where it gets overshoots. People will come in, build a lot of new supply, then the mining expansions will contract just as the supply is coming on. People will leave town, and you will find that there's an oversupply, and it goes straight down. And the other thing too, just to point out is 70% of the properties in these towns are investors. So they're not, it's a bit different if you had a strong owner-occupied market, you wouldn't see maybe as much volatility. But when you've got investors, if their rents drop, they start to get in trouble, they need to sell. And it's as well as it's an upward spiral, it's also a downward spiral on the other side.
I do remember that expo actually, and a young woman who would have been in her mid-20s from a company who was selling these mining town properties for around $1 million, and you and I were both talking there about being careful not to buy. And she directly approached me and says, you have no idea what you're talking about. There is that much iron ore up there. It's never going to run out. The bull run is never going to end. And I can remember saying to her, you give me a call next year and let's see what position we're in then. And of course, that really was the beginning of when everything started to go pear-shaped up there.
Yeah, and I remember, and there was a couple of those companies who were promoting the Pilbara. They're all no longer in business.
No, of course they're not. So I guess it's true, isn't it, that really it might seem like a fabulous idea to go into somewhere like a mining town now, give it a go, get in there now because we're saying it's pretty low and it's still on the way up, and then just try to time it to get out. But the biggest risk becomes that by the time you decide to get out, because it's still going up, and few people can get out when a market's going up. They want that bit more and that bit more. And because property does move relatively slowly, then by the time the tide's turned, it's going to be too late.
Yeah, absolutely. And you've got to set a trigger point at where you're going to get out and not get emotional about it and think, oh, there's a bit more to go, I'm going to hang on. And we are going to get out in our fund about when it's 10% below replacement, because that's when people are going to start going, bring on supply. There's already people sniffing around. Builders have left both those towns years ago because there was no way you could build anything because it was about half of replacement cost. But now the builders are coming back. So Karratha, they're starting to come back. They're starting to look around. I know one of the big mining companies wants 50 new houses built for their executives. So when you get construction happening, that's and when it gets to the point of construction, that's where we'll then tend to overshoot. So you've got to be really brutal about it, unemotional about it. And yeah, we all like to buy the exact bottom and sell at the exact top, but we can't be greedy about it. Leave a little bit on the table, and if you're far better off to maybe sell out 10% too early, then get to the other side. And when it falls off a cliff, it can fall pretty dramatically. Like demand can evaporate and I'd rather sell with a little bit left on the table than if I get to the other side and find I might take 20 or 30% on the way down.
Well, I can tell you, I bought a lot of property in my time and I own a lot of property now, and it's still not within my own comfort zone to be buying in a mining town. So, well, remember that tonight we're answering questions, and if we get to yours, then you'll be the lucky recipient of my Christmas book pack, comprising my 3 top-selling books. Now, they're designed to cover every aspect of property investing. These books leave no stone unturned, and they're suitable for beginner and experienced investors alike. Just email your questions to me at pim@mypropertytv.com.au, send a message via Messenger or post it on my Facebook page, and I'll be sure to pick it up and answer it on the show. Let's get started on our viewer questions tonight. Our first one comes from Kat, and Kat says, hello, so what are the perks for positive cash flow properties, and are there any negatives? New to investigating and keen to enter the property market, but I don't know if there's any downsides for positive cash flow and tax implications. Damian, I think one of the things about a question like this is that it still indicates to me that people think that positive cash flow is, I guess, a strategy, and they think that it is different. It's a different way of investing from a property that will give you a negative cash flow. And I suppose we first need to explain that whether a property is a positive cash flow or a negative cash flow depends on a whole range of things, including that individual investor's personal margin or rate of tax. And you can have 2 properties identical to each other side by side, owned by 2 different investors, and one would be positive and one would be negative.
Yeah, absolutely, Margaret. It depends on their individual circumstances, and ultimately, your property returns are going to come from a capital growth and cash flow, and so negative gearing, which has always been, we've been in a much higher interest rate environment, has been not all properties, but been certainly, I think most, particularly in the capital cities, there's been more negative geared than positively geared. And you're losing money every year. Even though you get some back on your tax, you're actually out of pocket. So you really need to be buying a property that's going to grow particularly strongly in terms of capital growth. So versus something that produces cash flow on a regular basis, then you're certainly getting some money up front. Yes, you're going to pay income tax on it, but unless you're even if you're in the 47% bracket, you're still going to keep at least half of it. And then you factor in depreciation, you may find even if it's positive cash flow, you might, after depreciation, pay no income tax on it at all. And so a property is a sum of its total return, which is growth and income. Now, I would prefer all my properties to be positive cash flow because that means I'm not dipping into my pocket. But there will be sometimes properties that I want to buy that I think the rental return might be quite low, perhaps, and I might have a negative return, but the capital growth is going to be substantial on the upside. So really, I guess is if I get a high growing property that gives me positive cash flow, I'd rather that any day over a high growing property that's losing me cash flow. Negative gearing in itself is not a strategy; it's just an outcome that helps you pay the bills. Now, of course, we're in a 2% interest rate environment. So, we're certainly in our office here in Perth looking at so many properties now positively geared anyway, and that's a bonus. I tell you, everyone would rather cash in their pocket than they would cash out of their pocket.
Yeah, and you took some of the words out of my mouth then. Kat, I could spend the entire show explaining this to you. Positive cash flow, as Damian has so rightly said, isn't a property, it's an outcome. And that outcome varies and it changes in your hold period as well. So a straight up positive cash flow property is probably one where once you take into account the income and all your tax deductions and then take into account the outflows, then you're ahead. You've got money in your hand. That could even be a property that looked negative initially. The income might have been less than the outgo, but because of depreciation and other deductions, you get enough of your tax back to plug up that difference, and on balance, there's more, at least $1 or more per year in your hand than there was when you started. So all different types of properties can be positive or negative. You can buy a positive cash flow property and in 6 months' time it might become negative because for some reason when you get a new tenant you can't get as much rent. There's so many things that influence it, and whether or not you buy positive or negative cash flow properties also depends on where you are on your investing continuum. If someone only has a few years left to retirement, they want properties that are more likely to grow very heavily, and those properties will more likely get lower rents, be in probably capital cities, and will be negative cash flow. If you've got a long time to retirement and you might be in a position where you've got a lot of kids and your job is only just making ends meet for you, you want your properties to be positive cash flow because you can't afford to be dipping into your own pocket, but you've got a long time to wait for that growth anyway, so that long-term growth comes into play. The bottom line for you, Kat, is don't try to do it all yourself or work it out for yourself. You need to have a skilled property professional who isn't going to just sell you a property, who can help you to work through what's the right outcome for you at this moment in your life, and to help you on a strategy that will remain appropriate for you over the coming 10 and even 20 years. Let's go to our next question, and this one comes from Leanne. And Leanne says, hi there. We have a 20-year-old daughter who wants to start saving for a unit or a house so she can move out. The prices around the Central Coast are going to be way outside what she could possibly afford repayments on. So do you have suggestions on how young ones these days tackle property investment? Damian, the Central Coast used to be the affordable option for people potentially in Sydney. They could live here and commute back to Sydney if they worked there. But in recent times, it's not only grown even before COVID, but COVID has brought into people's attention that they can actually live an hour and a half from Sydney because they're working sometimes from home. And it's put a lot of pressure on the prices here. And for young people, it's started to become very, very difficult to buy here, with probably minimum buy-in price for a house upwards of $600,000. What do you suggest for someone like that?
Well, it was interesting, Leanne. There, I think she wanted to move out, and she can't obviously afford in the Central Coast area, but still wants to get into property investment. Look, one of the things is that you don't necessarily have to invest in your same locality, and it might be that at age 20. obviously just starting out in the workforce, that your income might be a lot lower, but you still want to get on the property ladder. It may well make sense to find another location which may not even necessarily be in your own home state. Could be somewhere else around the country that is in your affordability bracket, and just rent in your hometown. Now, your circumstances might change, and you might find by the time you're 25, 26, depending on what you're doing for work, your income may have risen substantially, and you might want that home in your own hometown. Yeah, prices might have moved a bit, but guess what? If you've invested well, you've also created a fair bit of capital growth elsewhere. So I guess if you can't afford in your own hometown, and that's really looking like it's going to be that way for some period of time, well then I'd certainly recommend make sure you're not missing out on some capital growth, to look around other places around the country, and maybe at some stage in 5-7 years you can recycle that gain you've made back into a home in your own town. But look, you wouldn't be the first one who some people, and I've got clients in that situation where they've got 3, 4, 5 investment properties right now at this stage of life for a whole variety of reasons. They don't own a home and have no intention of buying a home right now. So there's a whole variety of reasons for that. So don't be fixated on necessarily getting into your own hometown right now. There might be better ways where you can still live there renting and go and buy somewhere else.
And that's very true. I do want to tell you, Leanne, that out of all of the children that I have, the ones who own property all bought investment property first, and a couple of them bought a number of investment properties first and did end up with their own home, but they were able to pull out growth out of some well-bought investment properties that they bought when they were 20, and then cycle that back into their own home even after the capital gains tax that they paid on them. So, there's certainly plenty of ways to skin a cat. You'll find in capital cities like Brisbane and Adelaide and Perth, there is highly affordable properties in the $300,000 price range that will get rents upwards of 5%, that will easily cover a mortgage repayment. And while your daughter is renting where she wants to live, and you'll find that proportionately the rents on properties Central Coast and Sydney are going to be lower and probably only be 3 to 4% of that purchase price. So while she's spending money on rent, she is investing at the same time, and her money is doing really well in those other markets, and it's a better way to go than just overcommitting yourself to something that she's not going to be able to afford. The initial deposits are smaller as well, easier to get, and if you want to help her out with that, with maybe a bit of equity from your own home, then that's very, very easy to do. So certainly plenty of people out there who can help you to do that. Obviously Destiny is one of them, but there's plenty of people out there who can help your daughter to get into the right position early on as an investor, and she can be one of those people. I think we have dozens of clients who, like Damian's clients, have 5 and 6 properties under their belt. They are on the property ladder, but they rent where they want to live, and so it tends to be a good strategy. Well, it is time for us to take a quick break, but you can email or message your question while we're gone and still be in the running for that book prize. There's lots to talk about tonight, so be sure that you stay tuned. We won't be gone long. Welcome back. You've tuned into the web TV show Property Investing Matters on My Property TV, and this is our very last show for 2020. I'm Margaret Lomas, and tonight Damian Collins from Momentum Wealth is helping me to answer your questions, and we're talking about mining towns and the Perth market. Remember that you will receive my fabulous Christmas book pack if we answer your viewer question on the show tonight, so don't waste any time. Email me those questions or send them via Messenger. Damian, just going on to our next topic tonight, which is commercial property, and we've talked a bit about that over the last couple of shows. Should you be considering that as part of your portfolio, given the situation at the moment?
Well, I've got commercial property, Margaret, as part of my portfolio, but it is a pretty obviously decent sized portfolio. But my philosophy on property is that residential is always where you want to start, and but it's not necessarily where you want to end. Now that will depend on how far along the journey you get to, and so there's pros and cons. So commercial is higher risk property, and particularly if you own it directly yourself, your commercial tenant could disappear, could go to business, the lease could come to an end, and I have one of my own properties myself where it's only a small part of my overall portfolio, but it's now been vacant for 2 years because the office market in Western Australia has been very challenging. Now I can wear that because that's only a small part of my portfolio, but if that was your only asset and you're relying on that as income, you'd be in some serious trouble. Residential, you can generally get a tenant in. You might have to adjust the rent, but generally within a month, if worst case 2 months, you should be able to fill that property again. But commercial does produce high yields, and the tenant pays all the outgoing. So right now, as you mentioned earlier there, in Perth, Adelaide, Brisbane, you can buy properties roughly 5% gross yields, but by the time you take out your costs, your net yield might be sort of 3.5%, potentially, and obviously if you've got no debt, that's 3.5%. That's a nice money in your pocket. But to get a 60,000, let's say it was 3% yield, or even at 3.5%, you need about $2 million of net property with no debt is going to get you 60 to 70,000 in return per year. On a commercial property, you might find that you can get 7.5%. So the cash return is going to be around 140,000 on a $2 million net property portfolio, so substantially more. So my philosophy is in when you're working and got another income stream, residential, and you don't need the income from your property, you focus on growth and wealth. Residential is generally where you want to be. Commercial does grow, but it is certainly a lot more volatile, and you tend to look at it more as a yield play rather than a growth play. But the thing is, as you get towards retirement, you might want to think about substituting some of that residential or stopping residential and then diversifying into commercial. But the challenge with commercial is that you generally need to buy a pretty decent asset of a decent size, and that's out of the realms of possibility for most people. We've got some clients in our business who are worth upwards of 100 million. They still don't buy direct commercial property because it's a lumpy asset. Could be 10 or 15 million for a decent asset. So they go into funds, and they're funds like we obviously run them through our mere property funds, commercial funds. We can put in 50,000, and you get an asset you get to invest in 6-7 assets with maybe 10 or 15 tenants across the country. You get 7.5% return. That works for some people because they can get to diversify. I think commercial is certainly high risk, unless you're, as I say, even these high net worth people now are starting to go into funds, and we're not the only one. There's other people out there. But I think my general philosophy is where we want to get to with our clients is if you're only ever going to get 1 or 2 residential, it's probably where you're going to stop. You just won't have the wealth and the risk profile to get to commercial. But if you're going to build a big portfolio, my philosophy is generally 50% resi, 50% commercial. That'll get you a blended yield of net 5. And so on a portfolio of 2 mil, net 5, and that'll be 100 grand income. Still should be growing though. If you've got a good quality portfolio, your resi will still grow as well, and that income will grow. So but it's not for everybody, and it's generally for most people, even myself. Knowing what I know now, you always learn lessons in life. I'll only ever go into funds again for commercial because it's just too big a lumpy asset in of itself on its own.
Let's talk about commercial property specific to Perth at the moment, because I know we do get people who are interested in investing in Perth, and also people who live there who watch the show who want to stay in their own state. I'm really curious to know what kinds of commercial property in Perth at the moment would be the best ones to consider.
Well, we've had an office market that's been pretty battered around from, again, Perth is very heavily reliant on the mining, oil and gas sector. So we had an oversupply of properties, and right now our vacancy rate in the office market's about 20%. And so premium or prime properties, it's much lower, around 6-7%. But when you get to D grade, and anything you buy as a strata unit or anything like that generally is going to be D grade. So office, in that space, it is around 40% in some cases, so it's pretty brutal. So office is a challenge. If you've got a good quality tenant and they're going to be there for 7 years and they're not going to go out of business, obviously you can, if it's a well-known and well-respected company with a solid balance sheet, well then it might make a bit of sense. But we are buying office, but well below replacement. So again, it certainly carries some risk, because if that tenant goes, they're not solid, you're going to find yourself with a significant vacancy period to get a tenant back. Retail, like all high street retail, but it's product retail, shopping centre retail, is in a pretty tough way. The only retail that we hold in our portfolio is neighbourhood centres. I'm still quite bullish on those, because when you talk to the asset managers at the big supermarket groups, they're not going to be shipping out of an industrial warehouse in the middle of an industrial to everyone's individual home. It's too expensive. They can't make any money that way. Their ultimate distribution strategy is it'll be click and collect from those neighbourhood centres. So that's how you're going to pick up your groceries in the future. Order online, click it and collect, and then for fresh stuff you might actually go in the store. So the floor plates will change, and then the specialties that are attached to those neighbourhood centres generally tend to be services. So your haircuts you're not going to get online, your nail salon, your cafes where you talk to people, they're not going out of business, they're still going to be around. We all need those services. So that's the only part of retail I particularly like. And in terms of industrial property, that is quite sexy now. I remember 15 years ago, everyone loved retail, everyone hated industrial, it was boring. Now you talk of the word logistics, everyone gets excited. But yes, we will have a further push towards distribution centres, but you've got to be very careful. Industrial, some of the warehouse facilities are no longer fit for purpose. In the US, Amazon are going 8 stories, believe it or not, 8-story industrial centres. So if you've got a 2-story industrial shed, that might not be fit for purpose anymore. So it's a lot more complex, a lot more research you need to do. But industrial's picking up, but it's got to be fit for purpose. It's got to be something that's built in the last 15 years. Anything 30 years older is generally suitable for a bulldozer.
Yeah, no, that's some really good points, and it's good to drill down into what's really happening in commercial property and to see that it's not a lot different in Perth, although we really, and we're the same here, we really have a move toward those industrial properties, the warehouses and those things that people are looking now to get. Let's go to more questions though, Damian. We've got quite a few to get through tonight. I want to go to this next one from Rob. And Rob says, hi there. What do you do to switch off? It seems every minute I'm not working, I'm researching property. I need a break, but I find it next to impossible to part with my phone. Given the impending break, do you have any tips on how to have a holiday from property? Wishing yourself, your colleagues and viewers a Merry Christmas, a great break, which is wonderful. And Damian, all I can say to this question is welcome to my life. That's been my life for my whole life. And even when I say I'm going to stop thinking about property and have a break, I go on holidays and I start thinking about property because I've got time.
Yeah, exactly. Look, Rob, if it's a passion and you love it, then if you're enjoying it and having a look, I guess it's all part of the fun. I love to look online as well, and sometimes given I'm in property day in day out, sometimes it probably is a bit easier for me to switch off because I can segregate that, and I like to have a bit of time away. But look, as long as you're not, one thing I think of people who do spend a lot of time online, they suffer from what they call paralysis by analysis, and they overanalyze and overestimate. We all want to make really good investment decisions in our lifetime. Are we going to make perfect decisions? No. I can tell you I've never made perfect decisions, and some have been far from perfect, and I'm sure Margaret can say the same. So getting a good investment outcome is not making those perfect decisions, because you'll end up spending your 24/7 and you still won't even get it right anyway. So just be aware that you want to learn enough to know the right questions you're going to need to ask of experts who are going to help you along the way, or if you're doing it yourself, make sure you do enough research. But you'll never get it perfectly right. And don't be suffering analysis paralysis by analysis. And if you're enjoying it though, well, there's nothing to worry about. It's all just a bit of fun and looking at what's happening in the market.
Rob, I have a saying, and that is that the fair property that you buy today is better than the fabulous property that you never get to buy, because you spend so much time looking for property and trying to make it perfect. I have many properties that are far from perfect, but I bought them and they're in my portfolio and they're working for me, not for someone else. And I think this is the problem. The longer you take to buy property, then the harder it's going to be for you to pull the trigger and buy something, and nothing will get into your portfolio, so nothing is growing for you. A couple of tips. First of all, limit yourself, and what I have always done is I've scheduled my property time into my calendar, just like I schedule everything else into my calendar. So put aside some time. I often have to tell clients to do this because they're clients who never get time to research, and they say, I don't have the time and I never get around to it, and they leave it till the last thing. You're the opposite, but you still need to schedule that time and tell yourself that outside of that time, you're not going to be doing the research. When you schedule that time, make it a decent amount of time so you get a lot done in that period of time. And when you finish, you don't feel the need to keep going because you don't feel unfinished. So schedule that time. It is easy to turn off the phone, maybe give it to somebody else. And one other tip that I've got is that I've switched some of my passion for looking at property to buy to a passion for looking at places to go on holiday. So I look over all the lovely properties on Airbnb that I want to holiday in and make a list, and it's a lovely way to spend my time. And when I'm doing that, I'm not thinking about buying property, I'm thinking about holidaying, and it makes me feel a whole lot better. Let's go to our next question. It's from Carolyn, and Carolyn says, hi Margaret, this question is more about lending than buying. We recently settled on a property in New South Wales and we were 2 weeks late to settle. We were charged a pretty hefty penalty by the vendor. The thing is, we were only late because the bank made errors on our loan documents twice and they had to be reissued each time. What recourse do we have for this penalty? As I don't feel we should have to pay it. She's got a good point there, Damian.
She sure do, Carolyn. And so your recourse, if you look at it from a legal point of view and you read the fine print from the lenders, they will have covered themselves. And I've had this situation ourselves with lenders who've, when we're doing the finance for them, have screwed things up right royally, as they sometimes do. So legally, they're likely to be no obligation to you. However, morally, and if you jump up and down enough, and whether you went to a bank yourself or whether you went through a broker, particularly if the broker's got a good relationship with the bank, we have jumped up and down and screamed, saying, well, this is your fault, lender. And we as a brokerage give you some serious business. We go to our BDM and say, pay up, and don't always win, because sometimes they'll argue that X, Y, Z happened and you took too long to do X, do a few things. But certainly, I think you've got a good moral case. Probably legally, you probably have no case and can't do much about it. But I would certainly, if you got a broker, I'd be getting them to scream at the lender and start jumping up and saying, well, my client's paid because of your error, and hopefully you can extract something out of them. But it's not easy. They don't like parting with their money, even when it's their fault.
Absolutely agree with that. I've had the situation myself where it's because of the lender, and as long as there was nothing you did at the beginning of the settlement to hold up getting that first set of loan documents, then you may well have a case to get the lender to at least partially refund some of those settlement or late settlement fees that you're paying. Depends on how much they were, but we've definitely, as Damian said, as brokers, we've definitely had success in chasing back to the lender and suggesting to them that they need to make things right for that buyer. And if you don't have a broker, then talk to the bank directly and see whether or not they'll come to the party on those late fees. Next question for this break comes from Jerry, and Jerry says, hi Damian, what is the medium-term outlook for Bunbury, Busselton and Albany, please? So Damian, we've got Bunbury about 2 hours from Perth, Busselton a little bit further. and then down to Albany, probably about a 4-hour drive. Would I be right?
Yeah, Albany's about 4. Bunbury's a little bit closer now that we have the freeway going all the way down there. So hour 30, hour 40, depending on the traffic conditions. So Bunbury's the biggest town of the 3, and it's about 50,000 now. In fact, it's the biggest town in WA outside of Perth. It's really a hub for a lot of the farm areas. So we do see a lot of grain go out of Bunbury. It's also got a port down there as well, and also for a bit of agriculture in terms of cattle also as well. So it's a real hub. So a lot of people will go into, even from the regional areas. I was going through Manjimup and other these places, and Bunbury is where they go and do their shopping for. There are a lot of local towns outside of Bunbury that are 3,000, 4,000, 6,000. They obviously don't have the shopping facilities and so forth. So, look, I think Bunbury will do reasonably well, but I can't see it outperforming in of itself Perth, because it still does have a bit of land in that area, and you're not getting in my opinion, the uptick in rental yield premium that I would expect. So if the yields down there were 1.5% more, you might go, well, Bunbury's a good place to be. But you're not really getting any additional yield premium versus Perth, so I can't see how it is likely to do any better. Now, Busselton's a tourist town, very much another sort of 45 minutes to an hour down the coast, and that's a real challenge when you look at the prices down there, because it's got the jet set of Perth down in Busselton and Dunsborough. The prices versus the rents there don't really seem to stack up as an investment. I've tried to look at it a few times. Now, there is an argument around COVID, and what will that do? People working remotely, and I've certainly had a real good look at that in our office, and where we see the outcome likely to be. Our view is that people certainly are going to work from more remotely and work from home more, but they still need to be, in my opinion, a catchable area where they can still come into the office that whether it's 1 day, 2 days, or 3 days a week. And so you mentioned earlier, Margaret, the Central Coast, hour and a half. We're certainly looking around the Mandurah region now as well. That's certainly an area that people are starting to look to relocate, where if you're coming in every day, it's a bit of a hike. It's 90 kilometres, and even if you jump on the train, it's a bit of a distance each way. But if you're only coming in 2 or 3 days a week, it suddenly becomes very manageable, and the lifestyle benefits you might get. So unfortunately, Bunbury, Busselton, particularly Busselton and Albany, just a bit that too far away. Bunbury, you might get a little bit of that, although it is still an hour and a half. It's a long way to come, even if you're just coming that 1 or 2 days a week. Albany is very much, again, a regional catchment area for the southern coast of Western Australia. It's got about 23,000 people in it. It doesn't... Nothing stands out there to me in Albany as to why that's going to outperform. Again, you've got plenty of land to develop if it ever starts to take off. It hasn't really done much over the last decade or so. All those 3 towns at the moment, particularly Albany's got the lowest vacancy rate in the state at 0.4%. Everywhere in WA is below 1% at the moment. So you're going to see some rents skyrocket down there. But I think eventually you will see supply come into the market to meet that. But it's not a high growth town. So that's my medium-term outlook for those 3 areas.
It might interest you to know, Damian, that for a very, very long time now, people have commuted from the Central Coast, which is minimum hour and a half, maximum about 2 hours by the time you get to the top of the coast, been commuting. I think 60% of the workforce commute to Sydney every day and don't think twice about it. Eventually, I imagine you'll get there in Perth. And now you're starting to talk about Mandurah as being in commutable distance. Well, to us, Mandurah would have just been a suburb of Sydney a long time ago. So over time, I think those areas will definitely start to grow a little bit faster. But I think for now, first of all, Perth has to do its job, and second of all, there's a mindset that has to change, and I think you're still a long way from that mindset changing in Perth, because there's been no need for people to do that kind of commute. Property's affordable on the outskirts of Perth, still very affordable, whereas on the outskirts of Sydney, then property wasn't affordable, which meant that people had no choice but to commute if they wanted to own their own homes. Okay, that's it for this break for our questions, and it is time for a next break. When we return, we will be answering more of your questions and continuing our discussion tonight, and we're going to talk about the Perth market when we come back. So stay there. We'll be right back soon with more. Thanks for being with us for our last show of 2020. It's always great to see you here on My Property TV. Don't forget to send your questions to us via Facebook or by emailing them to pam@mypropertytv.com.au. Damian, let's talk now about the Perth market. We always talk about it when you come on. We've been hopeful over the past few shows. What's happening now?
Yeah, it's definitely on the move, Margaret. Look, the headline figures are showing CoreLogic, I think, are coming up. Will come out this month. It's up about 2.5% or thereabouts for the quarter, and certainly in the last month it'll be over 1%. So we're definitely on the move. We've putting my REWA presidency hat on. We've forecast 6 to 10% growth for 2021. So ANZ have come out and said 12%. And all that oversupply has finally gone, and as often happens in property, it's like turning around the Queen Mary. If you want to bring in new supply to meet the demand, it takes a long time. Apartments could take 3 years, townhouses could take 2 years, and even single houses could take upwards of 18 months from conception through to actually being a dwelling. So we've got a shortage of stock, and there's a real FOMO, particularly in the established areas within that 20k radius. And some areas even a bit further out in the southeast and the northwest, there is often offer properties you'll see multiple offers. So, but we've got to keep it in context. We've got the cheapest median price around the country. When you look on an income basis, our income's far higher than Adelaide and Hobart, and yet their median prices were the same or even more. So I think there's some reasonable upside. I think. That we could see, I think we could see 15-20% uplift and still be fairly priced. And with interest rates so low, people are looking at the maths, and I'll talk about rentals in a second, but they're looking at the maths and going, gee, I can borrow 400,000 and pay 8,000 interest a year, or on a 400,000 in the property, I might be paying 20 to 25,000 in rent, and certainly rents are going very, very strongly. We've seen the vacancy rate come below 1% only for the third time in 40 years. I expect that we will pass the 0.8% 40-year low reached in 2007. Already at the moment, we're under a moratorium like a lot of places around the country, but unfortunately our moratorium's on every property, so we've got rent control right now. And so it's not often people are moving, because if they move, they're going to pay upwards of 15% to 20% more rent. When the properties do become vacant, our property managers easily getting 10% rent increases, and in some cases 25%. So when that moratorium pops in end of March in 2021, all these sitting tenants are going to see quite a substantial rent increase. So you can buy on 5% gross yields right now. And that's pretty good, and I think that might even the rents will jump, I think, quicker than the prices. So you might get to see 5.5 before we see the price accumulation start to catch up. So all being well, no COVID outbreak, it's certainly looking like the best conditions in probably a decade, and we are seeing the hollowing out. Perth used to see a lot of 25 to 35-year-olds leave and go east and see the bright lights of Sydney and Melbourne particularly. That certainly stopped due to COVID, and I think there's going to be a while before we start to see that happen again. And we know that there is a lot of East Coasters who've decided that from Perth originally and internationally have decided, look, given what's happened with COVID, the uncertainty in the world in the next few years, there is quite a lot of people wanting to come back. So that has certainly helped our population growth, and no doubt will in the next couple of years ahead.
Damien, do you think that once this sort of next year or two we're through that, and you've had some good growth over that time, 10, 15%, do you think you'll go back into another extended period of no growth? It's certainly been a long one this time. I remember the last time you had the good growth and property really doubled during that time, but then after that you came out of it and just sat and did nothing for such a long time that eventually, unless you'd been in just before that growth and got out just after it, the returns ended up to really smooth down to being not so good after all. Do you think that will happen again?
Look, I certainly hope we don't have a boom like 03 to 07. That was, I think, if if not once in a lifetime, maybe twice in a lifetime sort of crazy price growth, where it more than doubled in 4 years. And we're getting, I remember one year there was 35% growth, another year was 25% growth. I mean, that was just out of control. And sure enough, as you mentioned, we had mean reversion where we come back to the mean. And look, Perth tends to overshoot. Not as bad as mining towns, but we've in the last decade we've overshot to the bottom. I look out in the Southern Corridor, and before the recent price accumulation we've started to see, you could buy houses out towards Armidale for 220, 230,000. Now this is on a train line, probably 30, 35 kilometres out of the city. You can get a house, albeit 1970s, 1980s house, on 3 bed, 1 bath perhaps, but it's very rentable. You were getting even then $300 a week rent. And the fact that you could buy it for 230 was just mind-boggling. It was so ridiculously cheap. So we've overshot by our plateauing over the last decade. We've overshot to the point where when you pay more for a house in Hobart, and that's when you look at their income, ours is substantially higher here in Perth. When Adelaide's a higher house price, that doesn't stack up to me, and we should be somewhere in the vicinity of Brisbane. So Sydney and Melbourne are always going to be the most 2 expensive cities. They're the biggest. Any city around the world where you've got a lot of people, that's always that. People sacrifice more of their income on accommodation. Perth, Brisbane, Adelaide, 2 million in the case of Brisbane and Perth, about 1.3, 1.4 in the case of Adelaide. Decent sized cities, but they still do have land on the fringe. But you can build a block of land still for 200, 220 and build a house for another 200 there on top. So they're still quite affordable. So we're somewhere, we should be sitting up, I think, with Sydney 1 million, Melbourne in the 800s. I think Brisbane and Perth should probably be in the high 500s, and Adelaide probably around that 500,000 range. And we're not there yet. We're a fair way off that. And so I think those 3 cities have certainly a bit of upside in them. And whether, again, if we overshoot on the way up, we will have a longer period. I don't think a decade, but have a longer period of certainly plateauing. But I'm actually quite optimistic about house prices while we've got these record low rates. I mean, when you can borrow at 2%, I just think, remember all the bears and doomsayers talking this 10, 20, 30% decline, it was ridiculous. Certainly there was downside risk early days in COVID, but when the Reserve Bank was putting rates where they are, they were crazy predictions. And if we're going to be in a long sustained period of low interest rates, I think the outlook across Australia is certainly reasonably optimistic. It's maybe not the next 6 months, but certainly in the next couple of years ahead.
Damian, I bought 2 properties in the Armidale you speak of, although more to the point Brookdale, which is essentially Armidale, right at the beginning of that boom. So I bought them for 120. Well, I bought one for 120,000. That actually was on a giant block on 2 street frontages. Built a second dwelling on it for another 120,000. And during that boom, they went up to 300,000 each. So that happened in around about a 2-year period. The boom was quite amazing. But just for those people watching, even though there's been no further growth on that, and in fact a little bit, they've come off a little and gone down a little bit from there, I've still always had really fabulous rents on them for what I paid. So I'm only in for 120,000 each, and I'm getting rents up close to $400 a week on each of them. It's not bad.
No, it's pretty good, and certainly the rental demand out. I speak to agents out there and out the Armidale corridor, and it's going crazy at the moment. So hopefully, Margaret, your property manager's ready to put up your rent significantly in March when our moratorium comes to an end.
Probably not, because I find property managers are universally not good, except for the 1 or 2. I've got 1 or 2 good ones, but I'm not sure if my ones in Perth qualify as that. They'll probably ring me and let me know. Anyway, let's go to the remaining questions for this evening. The next one comes from Louis. And Louis says, hi, I have a house that I'm living in, almost fully paid off with a value of around $420. I want to buy land and build a brand new house in a new estate worth $460 where I would like to live. The old house will be rented as an investment property once I've moved out. Can I transfer $360,000 of my debt from the new property to the existing one to pay off the new house, get an extra $60,000 as cash for furniture and a new car, and rent the old house with a tax-deductible loan of $420,000? Oh, Damien, if only it were that simple.
I know, Louis. I wish it was that simple. And so many people think that the deductibility relates to the asset you're borrowing against. So a lot of people think, oh, I can go and buy, my investment property's gone up. I can go and whip out $60,000, and it's all tax deductible, isn't it? Because it's against my investment property. Well, sadly not. The ATO look at the purpose of your borrowing. So what did you apply that money to? And if you apply that borrowing to, Louis, to buy a new home that you are living in, then it unfortunately becomes non-deductible. And so I wish it was that simple, Louis, but no, you're going to have all that debt will be non-deductible, sadly. And if you are going to certainly split it, make sure you're very ideally you'll have two split loans, and make sure you talk to your broker about the right setup that, because you're going to have an investment property with some deductible debt and some non-deductible debt with that asset used as security. That's another area people get themselves in trouble to, is the mingling and mixing of deductible and non-deductible debt, and you can very easily find yourself in a situation where you're creating more non-deductible debt. So be very careful. Talk to your accountant. Decent broker will not to do, but if you're not sure about that, then go and talk to your accountant about how you should set that loan structure up so you don't mingle the deductible and non-deductible debt.
And Louis, a far better idea would be to sell the house you're moving out of. If you're moving out of it, you've got no reason to hang on to it, because obviously you don't want to live there anymore. So you would be far better off to sell that. It's a capital gains tax-free asset because you've been living there. Take the funds that you get out of that property and pay off its debt. Plough the remaining funds into the new home so you have a nice low debt on the new home that you're living in, and then draw back or leverage against the equity in the home that you're living in and buy a whole new investment property with a bigger loan, fully tax deductible, in an area that may even be a better investing place than you're in. I don't know where it is that you are, but it could be a better place to invest. And that way you're going to be getting a good rent on it, you're going to have a fully deductible debt, and you're up the right way financially. Certainly something that you need to talk to somebody who knows what they're talking about, not just any old broker who might know about money but not know about tax and tax deductions. Our next question comes from Kath. Let's go to it. And Kath says, hello. My daughter, who is 38, single and currently living interstate, is looking for some expert advice. She has equity in a house and is now looking at purchasing a unit which she would be purchasing off the plan, and it won't be completed until 2022. 1, do you recommend this type of purchase? 2, will a bank lend money to buy it? And 3, what are the pitfalls of purchasing a property off the plan? Well, Damien, we don't have another hour show to talk about the pitfalls of buying property off the plan, but maybe you can quickly answer the 3 questions.
Well, I guess the question, Kath, is this for owner-occupier or investment? If it's for owner-occupier and you understand that apartments generally don't grow in value as much as a house. In fact, they don't. They categorically don't, because you've got more building value than land. And there are risks buying off the plan. Look, it's if it's for investment, generally I think there'll be better options than doing that. Will the bank lend money to buy it? Generally, yes, they will, but they won't actually tell you that till just about when it's ready for settlement. You can't get pre-approval for 2 years out. So that's another risk of buying off the plan, because you've got to make sure that you're putting down a 10% deposit. You don't know for 100% certainty that in 2 or 3 years' time, when you come to settle, that you're going to be in that same financial position. If you don't settle, you lose your 10% deposit. So you can go to your bank now with us. I will, as of today, it looks good, but we're not going to guarantee you anything because we'll assess you at settlement. So be very cautious of that. But generally, unless it's a studio or something out of the ordinary, a bank will lend against the asset, but you should talk to a broker to make sure there's nothing particular about that complex or that style of property in your area that may make them lend less. Some of them might cap the LVRs at a bit lower rate. And there's as Margaret said, there's a whole raft of pitfalls about buying off the plan, and certainly you've got to go in your eyes wide open. For everybody who's made 5 or 10% on the way up due to a rising market, there's dozens who've lost money when it comes to settlement, where they've had to fork out more. So as a speculative bet, it's not very often they come off in your favour.
Kath, lucky for you, you've won the book pack tonight because I extensively talk about off the plan and all their dangers in at least one of the books that you're getting, probably in more than one. So it will be a really good guide for you. But just in a nutshell, generally the contracts favour the developer, so he will probably have a get out clause, although certainly in New South Wales that's no longer legal. We had situations during the big boom that we've just come through in Sydney where people would buy or sign up to buy a property off the plan, and 2 years later, when the property was actually worth significantly more than that person was buying off, then the developer would exercise a little fine print get out clause and get out of the contract and sell it to someone else. And that same get out clause doesn't apply in reverse, where if you find that the property is worth significantly less than you're paying, and certainly that has been known to happen many, many times, there's no getting out for you. The bigger problem than just, as Damian says, not being able to get the money when the time comes to settle is the fact that you can still borrow, but if the property is valued at less than what you're paying, you're only going to be able to borrow 80% of that lesser amount, not what you're paying. And if you haven't planned to come up with more deposit than they're asking for, then where are you going to get it from? So you'll be backed into a little bit of a corner there. I think the last risk, other than the ones that Damian has already pointed out for you, is not getting what you think you're going to get. So first of all, it can be very hard to visualise the finished product, and certainly those artist impressions are quite generous and enthusiastic. I've known someone who purchased a property off the plan and ended up with a bedroom with no windows, and while that was on the plan, they just weren't skilled enough to pick that up and ended up having this property that was difficult to sell because they had a bedroom with no windows in it. Which you wouldn't think could happen, but it did happen. The other thing is that generally under those plans, the developer can change them by up to 10% without having to tell you. And so he might make changes that just don't suit you, but you're still forced to settle on a property that you might not want after all. You can't get out of that contract. That's the most important thing I can say. Lots to worry about with off the plan, whether you're an owner-occupier or whether you're an investor. Let's go to our last question. It comes from Chris. And Chris says, "Hi Margaret, I was wondering if you've seen insurance premiums rise much for landlord's insurance coming out of COVID-19, or if they're dropping coverage for rental arrears. My Terry Shear insurance increased 23%, but it does cover arrears. Is it worth paying insurance at these rates or without rental arrears?" Damian, I think it's an issue that we won't have to worry about too much longer because we look like we're coming out of COVID, touch wood, at this stage, and we're not going to have all of those excuses for people no longer paying the rents. But I must say, when it comes to landlord's insurance in general, I was just mulling over this myself the other day and thinking that out of all of the properties in my portfolio and out of all of the money that I've forked out over the years in landlord's insurance, I almost wish it had have been one of those risks that I self-insured, because I think the fraction that I've got back would be less than 1 or 2%, and yet I paid all that money out.
Yeah, it's an interesting one, isn't it, Margaret? Look, I do take out landlord's insurance on my properties, and it's been very, very rare that I've ever actually had a claim. And for the viewers out there, most landlord insurance policies cover loss of rent if a tenant absconds, but and they also cover malicious damage, and also potentially if a tenant's not paying rent and you can't evict them. It takes, as we all know, in most states, it takes a long time to evict a tenant. That you will often get coverage for that as well. But you've got to assess the you've got to assess the risk versus the returns. Now, both Margaret and I have taken it out, and but perhaps we could have self-insured, and so you've got to assess the risk. So what happens? If you're paying X dollars per annum, and you don't pay that anymore, you still would want to have building insurance. I don't think anyone should self-insure on building insurance, but if you're self-insured on landlord's insurance, and you go, well, let's say the worst case happened, can I swallow that? Have I got the financial capacity to pay for the malicious damage, because I won't get much more than the bond. Most of the tenants who do malicious damage don't have any money to rub together to pay for anything excess above the bond. Am I going to be able to wear the loss of rent? And that's a personal judgment call. And look, insurance companies, I think, as we come out of COVID, They did cut the on policies that weren't in place. They did cut the loss of rent, certainly with the moratorium. I think we're going to see coming out of it, even when they do reinstall those types of insurance, that will be pandemic and exclusions. There'll be government policy exclusions. So I think it's going to mean that if we see something like COVID, even if you're insured, you won't be able to claim on it again anyway. So look, a personal judgment call. I haven't had the chance to sit down and do my numbers. I think I'll leave it in place because it's for the moment, but it's something you should always consider and be wary. There are plenty of people who don't have landlords policies and they survive, but you've just got to make sure you're in the financial position to survive and not get into serious financial difficulty if those worst case scenarios happen.
And I think, Damian, on balance, I'm talking about the fact that if I only had one, I think I'd undoubtedly take out that landlord's insurance, because my risk then is much higher of that one being the one that I have to pay out on. But with 40, then I think if it's one or two, the other 38 are there in place to build me up and protect me against that. You know what I'm saying? I think on a bigger portfolio, and when you think about the fact that you're paying out a premium on every single property in that portfolio, then all of that money paid out on the 38 properties that are probably never going to go into arrears could be paying for the two and then some that every year might go into arrears. Does that make sense?
Yeah, absolutely. And if you've got 40, you're probably paying somewhere in the vicinity of 12 to 15,000 a year. And you're exactly right. The chances of all 40 going pear-shaped at one time are almost negligible. And even the chances of 3 or 4 going pear-shaped at one time are pretty slim. It's generally that one off. Now, if you've got that one property, that could be a big financial hit. But if you've got a big portfolio like you or I, it's probably very unlikely that it's... in fact, when my property managers have come to me and said, "Oh, you've got a claim," I go, "Oh yeah, okay, whatever." Or this tenant's not paying, it hasn't bothered me. But yeah, if you've got one property, you really want to have a think of that through clearly, because if it is for you as a one property owner, that's 100% of your income you're missing. So have a really good think about it if you've only got one property.
I reckon you're going to go away and do the sums now, Damian, now that I've brought that up.
I'm probably going to cancel it next time it comes up.
Yeah, and it was honestly just the other day where I was just sitting there, because I'm always thinking of ways that I can cut costs all over the place. And I just thought, that landlord's insurance, I hardly ever use that. And look how much I'm paying out on it. And you're right, Damian, I would never cancel the building insurance, because that's a much bigger risk. If that goes, something happens to the building, then that's tens of thousands of dollars. But a good property manager should be all over those arrears straight up. And I think you can really kind of limit those arrears in many ways where maybe you don't necessarily need that landlord's insurance. That is not advice not to take out landlord's insurance for the viewers. So please be aware that on smaller portfolios, I absolutely would have that landlord's insurance. Well, that brings us to the end of another episode of Property Investing Matters, and to the end of the show for 2020, as we take a hiatus and give all of our wonderful experts a nice break. But don't worry, we will be back again late January with your favourite guests and some new ones as well. So be sure to stay tuned for detail about our exact start date. If we answered your question tonight, please send an email to pim@mypropertytv.com.au with the subject book prize. Tell me your name, address and which question you asked, and your books will be definitely on their way to you. Thanks so much, Damian, for being on the show tonight.
Great to be here, Margaret. And I think we looked at the beginning of the year, and I don't think we would have predicted how resilient the markets were when everyone was talking it down. So I think we're looking at a pretty good space for 2021, I think, for Australian property.
Well, look, I'm of the opinion that it can't get much worse, so it's all onwards and upwards from here. And if you would like to contact Damian, you can do so through his website, momentumwealth.com.au. You can email me at pim@mypropertytv.com.au, and there on the screen in a moment are all the ways that you can contact me. It depends on which one you prefer. I'm probably on there having something to say. Don't forget to check out my free educational podcast and vidcast at destiny.com.au. Be sure to sign up as a VIP at destiny.com.au. You get my free monthly newsletter and also our free weekly property update. VIP is all free, no catches, nothing to sign up for. And from me and the Destiny family, please have a safe and enjoyable Christmas. Look forward to a fab 2021 and get ready to plunge into investing as soon as we're back. We'll see you then, and Merry Christmas.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.